So picture this. You are looking at a nuclear power plant.
Right.
It is massive. It costs, billions of rupees to construct, and it is designed to run nonstop for 40 years.
A huge undertaking.
Yeah, exactly. But here is the catch. In 4 decades, when that plant finally powers down, it is going to cost an absolute fortune to safely dismantle it.
Oh, yeah. Handling radioactive waste, restoring the land, it is staggering.
Right. So today's deep dive is really about a massive accounting conundrum. I mean, how do you take a foggy multi-million rupee cleanup that won't happen until like the year 2060 and figure out how it impacts the financial numbers a company reports to you today?
Well, it essentially requires you to treat the financial statements almost like a time machine.
A time machine.
Yeah. I mean, when you are dealing with timelines that span generations, accounting standards force companies to drag those future realities right back into the present.
Wow.
They have to put a hard, heavily regulated number on the balance sheet right now, today.
And welcome to a new episode on the GE Advisors Ind AS Clinic podcast. Our mission today is to unpack exactly how that time machine works.
We are going to decode the incredibly intricate financial mechanics of infrastructure accounting.
Specifically, looking at decommissioning liabilities. So, whether you are an auditor frantically prepping for a review or a finance executive dealing with long-term assets.
Or just someone who is insanely curious about how the global economy actually keeps score.
Exactly. You are in the right place. But before we start breaking down the nuclear material, we need to establish some ground rules for the scenario we are exploring today.
Yes, first we have to get the mandatory disclaimer out of the way.
Right, of course.
So the views expressed in this deep dive are strictly the personal views of the author of our source material, and they are not binding on you.
We strongly advise that you seek the help of an expert before taking or, refraining from any action based on the views discussed herein.
Absolutely vital to keep that in mind.
And we also have some strict structural boundaries for our hypothetical power plant to keep the math clean today.
We do. To isolate the variables, the functional and presentation currency for this entity is strictly the Indian rupee.
INR.
Right, INR. Any currency other than the Indian rupee is treated as a foreign currency.
Which introduces all sorts of translation mechanics that we are definitely not dealing with today.
No, we are keeping it simple. Furthermore, the reporting period for our entity strictly begins on the 1st of April and ends on the 31st of March.
Okay, so that sets our playing field. But I want to pause for a second and just ask the most fundamental question.
Go for it.
Why should you, the everyday person listening to this, investing your hard-earned money in the shares of a listed utility company, why should you care about these dense accounting standards?
It is a fair question.
I mean, shouldn't you just look at the net profit number the company reports at the end of the year and base your investment on that?
Well, looking only at today's reported profit without understanding how it was calculated is incredibly dangerous.
Dangerous how?
Accounting standards, specifically the ones we are discussing today, dictate how massive future liabilities affect today's reported profits.
Right.
If a company could theoretically just hide its future cleanup costs, their current profit would look artificially amazing.
Oh, I see. You might buy their stock thinking they're this massive cash-generating machine.
Exactly. Completely unaware that they are sitting on a ticking time bomb of unrecorded future obligations.
Wow.
So the standards force them to recognize those costs today, which drops the profit to a realistic level. Without knowing these rules, you're basically flying completely blind as an investor.
That makes total sense. And that is exactly why the resource we are pulling from today is so vital.
It really is.
If you want to know where this fascinating case study originates, it comes directly from the issue repository on GAMPadvisors.com.
Yeah, and they host over 4,500 issues and detailed responses specifically on Ind AS and Indian GAAP.
4,500. That is wild.
And anyone can register for free. You just go to the website, register, and you can submit your own complex issues.
On Ind AS and Indian GAAP, right?
Yes. And you receive a detailed, authoritative response delivered directly to the inbox of the email you registered with.
So for an auditor who needs rock-solid documentation on how they addressed a highly technical application issue with a client, That repository is an absolute goldmine.
Without a doubt.
Now, today's specific conundrum was featured in the 197th edition of the Gap Advisor's Task Weekly newsletter.
Authored by C.A. Manish C. Iyer.
Right, the director of Gap Advisors. And it is published on LinkedIn. There are over 230 editions published to date.
It's a massive catalog of knowledge.
So if you are registered on LinkedIn, you really need to subscribe to the newsletter for free.
And, if you find yourself tangled in a unique corporate scenario that requires a bit more than a newsletter to solve,
You can actually book a one-on-one consultation on your specific issues on Ind AS and IFRS with the author directly from his page on topmate.io.
which is incredibly helpful.
Yeah. But I do want to make one structural note before we jump into the actual timeline.
Sure.
Today's entire discussion is framed under the Ind AS framework.
The Indian accounting standards.
Right. But for anyone listening globally, is this applicable outside of India?
Yes, absolutely.
Right.
Because there is no difference between Ind AS and IFRS, the International Financial Reporting Standards, for this specific topic.
Okay, good to know.
Yeah, so the entire discussion we are about to have perfectly applies to all entities following the IFRS framework globally. The logic and the mechanics are identical.
All right, perfect. Let's start the clock. We're going back in time to the very beginning of this project.
Day one.
Day 1. The date is April 1st, 2XX1. Our entity officially begins operations of a brand new nuclear power plant.
And the source material tells us this plant has a massive projected useful life of 40 years.
4 decades of continuous operation ahead of it.
Which is a long time for a lot of things to change.
Definitely. And we have our initial numbers on day 1. The cost of building this facility is recorded as 1,020,000 rupees.
Okay.
But here is the wrinkle that sets up our entire deep dive. That 1,020,000 is not just the physical concrete, the reactors, and, the control rooms.
No, it's not.
Included within that 1,020,000 is a specific amount of 10,000 rupees strictly designated for decommissioning costs.
And this brings us to a major accounting principle regarding long-term assets.
Well, I'm going to need a real-world analogy for this because to a layperson, that sounds completely backward.
How so?
You just finished building the thing today, and you are already charging yourself 10,000 rupees to tear it down.
Yes, exactly.
So I think about it like this. If I rent a beautiful historic venue for a massive party, the true cost of throwing that party isn't just the DJ I hired or the catering I bought.
Right.
The cost also includes the massive fee. I am legally obligated to pay the deep cleaning crew the next morning to scrub the floors and return that historic hall to its exact original state.
That is a highly accurate parallel.
I haven't paid the cleaners yet on the night of the party, but the moment I take that first balloon to the wall, I have incurred the liability of cleaning it up. Is that what we were talking about here?
You hit the nail on the head. You were describing what Ind AS 37 requires when dealing with provisions, contingent liabilities, and contingent assets.
Okay, Ind AS 37.
Right, and this standard interacts heavily with Ind AS 16, which covers property, plant, and equipment.
How do they interact?
Well, when a company builds a nuclear plant, or an oil rig, or even a chemical factory, they have either a legal or a constructive obligation to safely dismantle it, remove it, and restore the site when they're finished using it.
Okay, a legal obligation is obvious. The government regulator mandates the cleanup. But what you mean by a constructive obligation?
A constructive obligation is interesting. It arises when an entity's past practices, their published policies, or their specific current statements have created a valid expectation in the minds of the public.
An expectation of what?
That the entity will accept certain responsibilities.
Oh, I see.
Even if there isn't a specific law on the books yet, if the company publicly promised the local community during the planning phase that they would turn the plant back into a green park in 40 years, they have constructed an obligation.
Because they can't back out without massive reputational damage.
Reputational and potentially legal damage, yes. So accounting rules dictate that this obligation must be recognized immediately.
So the moment you pour the first foundation, you are on the hook.
You are. If you only recorded the $1,010,000 it cost to build the physical plant and just ignored the cleanup, you would be drastically understating the true cost of operating that asset over its life.
Right, right.
So Ind AS 16 says you must estimate the cost of dismantling and removing the item, and you must capitalize that cost.
Capitalize meaning.
Meaning add it to the initial carrying amount of the asset, right there on day one.
Which gives us our 1,020,000 total capitalized cost, with 10,000 of it being the liability side of the equation.
Correct.
But here is the wildest number in the source text. That 10,000 rupee liability recorded today on April 1st, 2XX1.
Mhm. It actually represents an estimated 70,400 rupees in cash flows that will be payable in 40 years.
Yes, the text specifies the future cash flow is discounted at a risk-adjusted rate of 5%.
Okay, I need to pull out my calculator here. I mean, how does an obligation to write a check for 70,400 become a 10,000 liability on the books today?
This relies entirely on the concept of the time value of money.
Right.
It is central to how we measure long-term liabilities. The core idea is simple. A rupee in your hand today is worth more than a rupee promised to you tomorrow.
Because I can invest the rupee I have today and earn interest on it.
Exactly. So we reverse that logic to figure out liabilities.
Reverse it how?
The company's engineers run the projections, right? They look at expected inflation, future labor costs, waste disposal fees.
All the future variables.
Yep. And they estimate that on March 31st, 2x41, 40 years from now, they will need exactly 70,400 rupees in actual cash to pay the demolition crews.
That is the physical cash that will leave their bank account. Right. But the accounting question is, what is the true economic burden of that future payment right now?
Today.
To figure that out, we discount that future estimated outflow back to its present value. The text tells us they are using a risk-adjusted rate of 5%.
I want to focus on that phrase for a second. Risk-adjusted. Why not just use the rate of, I don't know, a standard government bond or a corporate savings account?
Because a 40-year projection for a nuclear cleanup carries immense specific risks.
Like what?
Well, what if the technology to handle radioactive waste doesn't advance as quickly as we hope? Or what if specialized labor becomes wildly expensive?
Oh, sure.
Paragraph 47 of Ind AS 37 dictates that the discount rate must reflect current market assessments of the time value of money, but also the risks specific to the liability.
So the 5% rate represents an agreed-upon estimate that accounts for both the time horizon and those specific uncertainties.
Exactly.
So let me just run the math to make sure I get it. You use a present value formula. You take the future cash flow of 7,400 and you divide it by 1 plus the discount rate, raised to the power of the number of years.
Yep, you got it.
So that's 70,400 divided by 1.05 to the power of 40. I'm tapping this into my app right now. Let's see, 1.05 to the power of 40 is roughly 7.04.
And if you divide 70,400 by 7.04,
So you get 10,000.
that is your present value.
Wow.
What this math proves is that if the company took 10,000 rupees today, put it in a dedicated investment account yielding a steady 5% annually, and just let it compound for 40 years, it would grow to exactly 70,400 rupees.
That is fascinating. So that is why the true economic burden on the company today is only 10,000 rupees, and that is all they record on the balance sheet.
Yes, it prevents the balance sheet from looking artificially bloated.
Yeah, I mean, if they put 70,400 as a liability today, it would look like they're in massive financial trouble.
Even though they literally have 40 years to generate the cash to pay for it.
Right, so it boils a massive future event down to its exact economic weight on day one.
Exactly. So on April 1st, 2XX1, we have an asset worth $1,020,000 and a liability worth $10,000 ready to start depreciating and unwinding.
Okay, so we have our beautiful, perfectly balanced spreadsheet, but estimates are just highly educated guesses.
Sure.
Let's fast forward a full decade and see what happens when reality collides with that 40-year plan.
10 years later.
Yeah.
Yeah.
It is now March 31st, 2x11. The plant has been generating electricity for 10 years. But the source text throws a massive curveball here.
It does.
On this exact date, the value of the decommissioning liability has suddenly decreased by 8,000 rupees.
And we have a crucial parameter given in the text. The discount rate of 5% has not changed.
Wait, I am looking at an 8,000 rupee drop in an obligation, but the interest rate environment is completely static.
Correct.
We need to investigate why this happened. How does a liability shrink by almost its entire original present value?
To figure this out, we have to turn to the standard itself.
Okay,
Specifically, paragraph 3 of Appendix A to Ind AS 16.
what does it say?
This appendix is literally titled Changes in Existing Decommissioning, Restoration, and Similar Liabilities. It acts as our diagnostic tool.
Like a checklist.
Exactly. It states there are only 3 possible events that can change the measurement of an existing liability.
All right, let's run through them. What is the first one?
First, a change in the estimated outflow of resources embodying economic benefits.
In plain English.
A change in the estimated future cash flows required to settle the obligation.
So a change to that 70,400 future check. Got it. What is the second?
Second, a change in the current market-based discount rate.
But the text explicitly ruled that out.
Hmm.
The 5% rate hasn't changed, so it cannot be option 2.
All right.
What is the third?
Third, an increase that reflects the passage of time, which accountants call the unwinding of the discount.
Okay, I want to stop and unpack unwinding. This is a term that trips a lot of people up, including me.
It's a tricky phrase.
Why does the passage of time change the liability? And why does the standard specify an increase?
Think back to our bank account math. The liability started at $10,000. It is mathematically programmed to grow to $70,400 over 40 years at a 5% compounding rate.
Right.
Every single year that passes, that liability gets closer to its final maturity.
Okay.
In year 1, the liability grows by 5% of 10,000. That is 500 rupees. The company records a finance cost in their profit and loss statement for 500, and they physically increase the liability on the balance sheet to 10,500.
Oh, I see. So in year 2, it grows by 5% of 10,500.
Yeah.
It compounds.
Yes. This compounding process is the unwinding of the discount.
So it's basically gravity pulling it toward that final number.
Exactly. Because it is compounding its way up to the final huge number, the unwinding of the discount will always, mathematically, cause the liability to increase. It can never cause a decrease.
Okay, let's review our diagnostic list then. The discount rate didn't change, ruling out option 2.
Right.
Time passing only makes the liability go up, so it cannot be option 3, causing an 8,000 drop.
Correct.
By process of elimination, we are left with option 1.
The querist in our source text didn't explicitly state the reason, but based on the rules, the author of the response correctly assumes that the reduction must be due to a massive change in the estimated outflow of cash required at the end of the 40 years.
So the actual projected cost of the cleanup has just dropped.
Significantly.
But, 10 years into an industrial project, what on earth gets cheaper? Give me some realistic scenarios where engineers would suddenly slash their cost projections by that much.
Well, 10 years is an absolute eternity in industrial technology.
That's true.
Consider a scenario driven by technological leaps. 10 years ago, the plan to dismantle the radioactive core might have relied entirely on human labor in highly specialized hazmat suits.
Working incredibly short, inefficient 15-minute shifts.
Very slow and very, very expensive.
But a decade later, robotics has advanced.
Exactly. In year 10, let's say a new class of radiation-hardened autonomous robotics has been commercialized. These robots can work 247 inside the containment zone. The engineering team recalculates the labor hours required in year 40, and the projected cash cost just collapses.
That makes total sense. What about non-technological reasons, say regulatory changes?
That is another highly probable scenario.
Like what?
Perhaps when the plant was built, the law required the company to transport all nuclear waste to a deep geological repository thousands of miles away.
The transportation logistics baked into that 70,400 estimate were probably astronomical.
Exactly. But then, in year 8, the government authorized a secure regional disposal site only 50 miles from the plant.
The logistics costs evaporate.
Completely. So in either scenario, the engineers hand the accountants a new, much lower estimated future cash flow.
Right.
And when the accountants pull that new, lower number back to the present day using the exact same 5% discount rate, they end up with the present liability that is 8,000 rupees lower than what was sitting on the books yesterday.
Okay, that solves the mystery of the decrease.
We know why it happened.
But this throws us right into a massive accounting dilemma.
It does.
We have an 8,000 rupee drop in a liability. The central query from the source file asks, how will the entity account for this change if it adopts the cost model?
Right, the cost model.
Because in double entry bookkeeping, if a liability drops by 8,000 on one side of the ledger, that money has to go somewhere else to keep the universe in balance.
Every action requires a corresponding reaction.
Okay, I'm going to put on my greedy CEO hat for a moment here.
Let's hear it.
My engineering team just achieved a massive win. They found a cheaper way to clean up the plant, and my company's liabilities suddenly dropped by 8,000 rupees.
Yep.
My net worth technically just went up. I want to claim that 8,000 reduction as an immediate windfall profit for the year.
Naturally.
I want it on my income statement as other income, so I can show Wall Street a huge quarterly beat and secure my year-end bonus. Why can't I just take the profit?
You cannot take the profit because Ind AS 16 is explicitly designed to prevent that exact kind of volatility. Yes, and frankly, that kind of performance manipulation. We have to look closely at the exact wording of paragraph 5 of Appendix A.
What does the strict rule say?
Paragraph 5 states, if the related asset is measured using the cost model, Changes in the liability shall be added to or deducted from the cost of the related asset in the current period.
Wait, I have to deduct it from the asset. I'm completely blocked from touching the income statement.
Completely blocked. The official response to the query is absolute.
Wow.
The company must reduce both the decommissioning liability and D, the cost of the physical asset, by 8,000 rupees as of March 31st, 2x11.
Okay, I hear the rule, but I really want to argue the logic here.
Go ahead.
Why is my physical asset being punished, meaning reduced in value, just because my future cleanup liability got cheaper? The plant still generates the exact same amount of electricity.
It comes down to the matching principle and the holistic nature of the historical cost model.
Break that down for me.
Think back to day one. How did that initial 10,000 liability get onto your balance sheet in the first place?
We added it to the cost of the physical plant. The concrete cost $1,010,000 in cash, and we slapped the $10,000 future liability on top, giving us a total capitalized asset cost of $1,020,000.
Right. The standard views the decommissioning cost not as a separate, independent financial event, but as an unavoidable final part of the cost of acquiring and using that specific asset.
Oh, I get it.
The liability was inextricably linked to the asset's DNA from the moment you poured the concrete.
So they are married.
They are completely married. If 10 years later you discover that your initial estimate for the cleanup was drastically too high, it means, retrospectively, the true cost of owning and operating that nuclear plant was lower than you initially thought.
Ah, I see. Because the cleanup is cheaper, the asset itself was actually a cheaper investment all along.
Precisely. If the liability is inextricably linked to the asset, a reduction in the liability must reduce the asset's capitalized cost to correct the historical record.
That is so logical.
If the accounting standards allowed you, as the CEO, to artificially inflate this year's income statement with an 8,000 ever profit, you would be drastically mismatching the economics.
Yeah, I'd be taking a change in a 40-year capitalized estimate and treating it like I just sold an extra 8,000 rupees worth of electricity this week.
Exactly. It would distort the current year's operational performance.
It would make me look like an operational genius for a quarter,
Yeah.
based entirely on a spreadsheet recalculation of an event 30 years in the future.
It would be an illusion. The cost model ensures the balance sheet reflects the true holistic cost of the plant. If the liability shrinks, the asset must shrink to maintain the integrity of the historical cost principle.
Okay, that makes profound logical sense. It is deeply conservative and entirely prevents manipulation.
It does.
But, we are dealing with math, and math always has extreme boundaries.
True.
What happens when the numbers swing so wildly that the standard rules break down? Let's explore some edge cases here.
Let's do it.
We know the rule. Deduct the liability drop from the asset. But there must be a mathematical limit to how far you can drop an asset's value.
There is, and it's a vital caveat buried in paragraph 5.
What is it?
The standard states, the amount deducted from the cost of the asset shall not exceed its carrying amount.
So a floor limit.
Yes. Under the cost model, an asset cannot have a negative carrying amount.
Right, you can't have a nuclear power plant sitting on your balance sheet with a value of minus 5,000 rupees.
Exactly, because that violates the fundamental definition of an asset,
Which is?
a resource controlled by the entity expected to generate future economic benefits. If an item has a negative value, it implies it will drain economic benefits from the entity.
Which would make it a liability, not an asset.
Correct.
So let's construct a hypothetical scenario where we hit this floor.
Okay.
Let's say we are 10 years in, and after a decade of heavy depreciation, the carrying amount of our physical nuclear plant has been whittled all the way down to only 5,000 rupees.
All right, following you.
But miraculously, the engineers discover a way to almost entirely eliminate the nuclear waste, and our liability drops by a massive 8,000 rupees.
A drastic scenario, but let's walk through the mechanics of the standard.
According to the rule, I need to deduct the 8,000 liability drop from the asset, but my asset is only worth 5,000.
Right.
If I deduct 8,000, I get a negative 3,000 asset, which we just established is illegal in accounting. So where does that remaining 3,000 go?
This is the specific edge case where the standard provides an exception.
Okay.
Paragraph 5 continues. If a decrease in the liability exceeds the carrying amount of the asset, the excess shall be recognized immediately in profit or loss.
Huh. So my greedy CEO finally gets a win on the income statement.
But only out of sheer mathematical necessity.
Right.
The
Yeah.
steps are strict. First, you reduce the asset down to absolute zero. You take the carrying amount from 5,000 to zero.
That action absorbs 5,000 of the liability decrease.
Yes. The remaining 3,000 of the decrease has nowhere left to go on the balance sheet. It literally cannot reduce a zero asset.
So it spills over.
Therefore, the standard allows the difference to flow through the income statement as a gain in the current period.
Because it represents an unexpected release from an obligation that is so overwhelmingly large, it has completely subsidized the remaining value of the physical plant itself.
Exactly. It is rare, but the standards must account for these mathematical boundaries.
Now, I want to flip the scenario entirely based on the final part of the source text.
Okay, let's flip it.
We have spent all our time talking about what happens if the liability drops. What if the liability goes up?
Oh, that's a whole different ballgame.
What if the government passes incredibly strict new environmental laws in year 10, and the projected cost of cleanup suddenly doubles?
Then the dance works in reverse. If the liability goes up by 8,000, the rule says you must add that 8,000 to the cost of the related asset.
So my asset just got more expensive on paper.
It did. And this triggers an immediate, severe warning system within the accounting framework.
A warning system.
Yes. The text in paragraph 5 explicitly warns, if the adjustment results in an addition to the cost of an asset, the entity shall consider whether this is an indication that the new carrying amount of the asset may not be fully recoverable.
I really want to dig into that phrase. Fully recoverable. What does that mean in practical terms for the company?
It is the standard asking a very blunt question. Is this plant actually worth what your balance sheet says it is worth? Let's say the carrying amount of the plant was 90,000. Suddenly, because of new environmental laws, you have to add a massive new cleanup liability, and the carrying amount of the plant jumps to 150,000.
So on paper, it looks like I have a much more valuable asset.
But is it actually more valuable? Does a more expensive, legally mandated cleanup make the plant generate a single extra kilowatt of electricity to sell to the grid?
No. The revenue potential hasn't changed a bit. Only the burden of owning it has increased.
Exactly. So you now have a plant sitting on your books valued at 150,000, but based on the electricity it can produce, it might only be capable of generating 100,000 worth of cash flows over its remaining life.
So I'm underwater.
If this happens, you have a bloated, overvalued asset. And the standard says this massive addition to the cost is an automatic trigger to invoke Ind AS 36.
Okay, Ind AS 36, that is the impairment standard, right? Walk me through how an impairment test actually works here.
When triggered, you must formally test the asset to find its recoverable amount.
Recoverable amount.
Yes, the standard defines recoverable amount as the higher of two things: the asset's fair value, less costs of disposal, or its value in use.
Wow, that is some heavy jargon.
It is. Let's break it down.
Break down fair value, less cost of disposal versus value in use for me. Are you basically saying we either have to prove the plant will generate enough cash if we keep running it, or that we could sell it to someone else for that much today?
That is the perfect translation. Fair value, less costs of disposal, is essentially asking, if we put this nuclear plant on the open market today, what would a willing buyer pay for it, minus the broker fees to sell it?
Right. And the other one?
Value in use, on the other hand, is an internal calculation that asks, if we keep operating this plant for the next 30 years, what is the present value of all the future cash we will earn from selling electricity?
And you take the higher of those two numbers.
Correct. Let's say you do the math, and the higher of the two numbers, your recoverable amount is 100,000.
Okay.
But remember, after adding the new liability, your carrying amount on the books is bloated at 150,000.
Because of the massive new cleanup cost.
Right. Because your recoverable amount is less than your carrying amount, you must immediately recognize an impairment loss in the profit and loss statement.
Ouch.
You have to write the asset down by 50,000 to bring its value back to reality.
That really shows the deeply conservative nature of accounting.
It does.
If the liability shrinks, you smoothly reduce the asset, and the standard completely blocks you from taking a quick profit.
Yep.
But if the liability grows and inflates the asset, the standard immediately steps in with a hammer and says, prove to me this asset is actually worth this new higher number. If you can't prove it, you are taking a massive loss on your income statement right now.
It is meticulously designed to protect the user of the financial statements from dangerous over-optimism.
That makes a lot of sense.
It prevents corporate management from hiding massive future cleanup costs inside artificially inflated asset values that will never actually generate enough cash to justify their existence.
I want to pivot now and look at all of this through the lens of the person we talked about at the very beginning of the deep dive.
The investor.
The everyday investor holding shares in this company. We have gone incredibly deep into present value calculations, the unwinding of discounts, and impairment triggers.
We have covered a lot of ground.
But what does this all mean for you, the investor, looking at the financial statements at the end of year 10.
Let's look at the scenario where the liability dropped by 8,000.
Right. The company reduced its asset by 8,000 and its liability by 8,000. The CEO was blocked from putting a big profit spike on the income statement.
Yes.
So, as an investor, did you actually benefit at all from the engineers finding a cheaper way to clean up the plant?
You absolutely benefit, but the benefit flows through the mechanics of depreciation, which provides a much smoother, more sustainable reflection of the company's value than a gimmick profit.
Let's do the math on the depreciation then.
Yeah.
How does this deliver a win to the investor?
Let's establish the baseline. At the start of year 10, before this liability adjustment happened, let's assume the carrying amount of the plant was 90,000.
Okay, 90,000.
And there are 30 years of useful life remaining on the plant. Under standard straight-line depreciation, the company was expensing 3,000 rupees every single year.
They take the 90,000 value, divided by 30 years, and get a 3,000 depreciation expense.
Exactly. And that 3,000 expense was reducing their reported net product every single year.
Right.
But then on March 31st, 2x11, the liability drops, and the standard forces them to reduce the asset by 8,000.
So the new carrying amount of the asset is suddenly 82,000.
It shrank.
It shrank. Now, what happens to the depreciation calculation for the remaining 30 years?
The company must depreciate the new, lower carrying amount of 82,000 over those remaining 30 years.
Let me calculate that. 82,000 divided by 30 years, that gives me roughly 2,733 rupees per year.
The depreciation expense drops from 3,000 a year down to 2,733 a year.
Wow.
The annual expense is almost 267 rupees lower every single year for the next 3 decades.
And if an expense is lower, the reported net profit is
Higher, by exactly 267 rupees every year.
That is the magic of the cost model.
It is incredibly elegant. Reducing the cost of the asset in year 10 means the depreciation expense for the remaining 30 years of the plant's life is permanently lower.
That's huge.
This translates to slightly but consistently higher reported profits in all future years. The accounting rules have taken the economic benefit of the 8,000 reduction in liability, and instead of allowing a volatile one-time spike in year 10 profit, it spreads that benefit evenly over the remaining useful life of the plant.
It perfectly matches the benefit to the period in which the asset is actually operating and generating electricity.
Exactly. It provides the investor with a smoother, more predictable earnings trajectory.
Because predictability is what investors actually want.
Think about the alternative. If the CEO could just take the 8,000 as profit in year 10, you, as an investor, might look at the income statement, think the company had an incredible year of selling electricity, and buy more stock.
Only to be deeply disappointed in year 11 when the profit drops back down to normal.
The standards protect you against that illusion.
It forces the financial statements to reflect reality, not just a snapshot of a mathematical recalculation.
Very well said.
It tells the true, evolving story of the life cycle of the project. We built it, we operated it, we found a cheaper way to clean it up, and therefore, it is slightly more profitable to run every day from now until the very end.
That is the essence of why these dense, paragraph-heavy accounting standards exist.
They're not just bureaucratic red tape.
No, they are the rules of translation, turning complex physical and temporal realities into a language that an investor can trust.
Before we wrap up this deep dive, I want to pose a broader question.
Go for it.
We just spent this entire time discussing the mechanics of a single nuclear plant and a single estimate change. But if you connect this to the broader global landscape, the scale is staggering.
The implications are massive, especially in our current era of rapid industrial change.
Seriously.
Think about the global energy transition away from fossil fuels. Think about every legacy oil and gas company, every massive coal mining operation, every aging nuclear fleet on Earth.
Oh, wow.
They all have thousands of these decommissioning liabilities sitting on their balance sheets, projected decades into the future.
My provocative thought for you to ponder is this. As technology rapidly advances, particularly in green energy, AI, and autonomous robotics, how many of these legacy energy companies have massive decommissioning liabilities that might drastically shrink over the next 30 years?
Meaning they're sitting on massive hidden equity that the market hasn't priced in yet because the accounting will only slowly release it through lower depreciation.
Exactly. Or let's look at the dark side of that coin.
There's always a dark side.
As environmental regulations become exponentially stricter globally, how many of those liabilities are wildly underestimated today?
That is a terrifying thought for an auditor.
How much hidden risk is buried in those 40-year forecasts? If a massive coal company suddenly has to quadruple its cleanup estimates, the impairment tests we discussed today could wipe out billions in asset value overnight.
It absolutely could.
The numbers on the balance sheet today are just a snapshot of our current flawed ability to predict the future. The real story is how those numbers will inevitably change.
The balance sheet isn't static. It is a living document trying to capture a moving target.
I want to thank you for taking the time to learn today. Thank you for going down this complex, highly technical rabbit hole with us.
It was a deep one.
It is dense material, but as we have seen, it is the absolute key to understanding the true mechanics of corporate finance.
If you found value in decoding the muddy waters of Ind AS 16 and decommissioning liabilities today, please follow or subscribe to the Gap Advisors Ind AS Clinic podcasts.
Yes, please do.
You can find us on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen on.
And for real-time knowledge, I highly recommend you follow the Gap Advisors Ind AS Clinic channel on WhatsApp.
It's a great resource.
It is the fastest way to get instant updates on all new videos, podcasts, newsletters, new issues that have been responded to on the repository, and updates on any new accounting standards issued by the regulators.
Finally, we have a request. Please share this deep dive among your contacts.
Send it to your colleagues, forward it to your audit and finance teams, and especially share it with students who are currently pursuing their CA course.
The application of Indian accounting standards is notoriously tricky, and spreading this practical, scenario-based knowledge helps everyone.
Until next time, remember that the financial X-ray machine might be broken when looking 40 years into the future, but with the right accounting standards in hand, you don't need an X-ray.
You just need to know how to read the map.
Thank you for listening.